If you keep any part of your savings in cash, in a money market account, in bonds, or in anything that assumes interest rates are about to fall, I need you to stop whatever you are doing and listen to the next few minutes carefully, because something happened 8 days ago that directly changes the math on all of it, and almost nobody explained it to you in plain language. Here's the sentence that should stop you cold. Last week, 3 officials inside the Federal Reserve did something they almost never do. They looked at the rest of the committee. They looked at a chair who wanted to hold rates steady, and they said no, not no to a cut, no to holding still at all. They wanted rates higher right now, and they were willing to put their names on that disagreement in public record for history to judge. That has not happened at this scale in years. And the market, which spent all of this year assuming the next move from the Fed would eventually be down, quietly flipped its own bet. Right now, the probability being priced for a rate hike in September sits at roughly 2 out of 3. Read that again. Not a cut, a hike. The exact opposite of the story you have been told all year. I am going to walk you through exactly what happened, why 3 people inside the most powerful financial institution on earth were willing to break from the group, what it does to gold, to silver, and to anyone sitting on cash waiting for rates to fall, and why the same week this happened, the world's central banks were quietly buying gold at a pace that has not been seen in years. Stay with me, because by the end of this, you are going to understand something that the majority of people holding cash, bonds, or gold right now have not yet connected. And that gap in understanding is exactly where money is made and lost in the next few months. Here's the twist, and I want to give it to you now instead of making you wait, because everything else in this video builds on it. Everyone assumed gold needed rate cuts to keep rising. Lower rates make gold, which pays no interest, more attractive relative to cash and bonds. That has been the textbook relationship for decades. And it is why so many people expected gold to struggle the moment hike odds started climbing again. But something strange happened underneath the surface this year. Even while rate cut expectations evaporated, even while a hike became more likely than a cut, the largest and most disciplined buyers of gold on the planet did not pause. They accelerated. In the second quarter of this year alone, the world's central banks purchased 289 tons of gold. That is a 74% jump from the same quarter 1 year earlier. Read those 2 facts side by side. Rate hike odds rising, which is supposed to be bad for gold. Central bank buying accelerating at the fastest pace in years, which only happens when the world's most sophisticated institutions believe something bigger than a single interest rate decision is unfolding. Both of those things are true at the exact same time. And understanding why is the entire point of what I am about to walk you through. Before I go further, I want to know who is actually watching this with me right now, because your answer changes how the rest of this lands for you personally. Tell me in the comments where in the world you are watching from, and tell me honestly whether your savings right now are mostly sitting in cash waiting for rates to move, mostly in bonds, or already positioned in something like gold or silver. I read these. I promise you the pattern in the comments on a video like this tells its own story about how many people are still positioned for a world that may no longer exist. And I will come back to what that pattern usually reveals before we are done. Let me lay out plainly what actually happened, because the sequence of events matters more than any headline summary. On July 29th, the Federal Open Market Committee met and voted to hold the federal funds rate steady in the range it has sat in for months. On paper, that sounds uneventful. A hold, no change. The kind of outcome that barely makes the evening news. But underneath that headline sat something far more revealing. 3 separate officials on that committee dissented from the decision to hold. And their reasoning was not that rates should come down faster to help the economy. Their reasoning ran in the opposite direction entirely. They warned, in language unusually direct for a body that typically hedges every sentence, that waiting too long to act could eventually force the Fed into a far more aggressive and more painful round of tightening later. In other words, 3 of the most informed people in American monetary policy looked at the current data and concluded that the danger is not that the Fed is moving too fast. The danger is that it is not moving fast enough. That dissent landed in a market that had spent the better part of the year leaning the opposite direction, expecting cuts, positioning portfolios for cuts, pricing bonds for cuts. When that assumption cracked, the repricing was immediate. Within days, the market's own tool for gauging future Fed decisions swung to show close to a 70% probability that the next move, arriving as soon as September, will be a hike rather than a cut. Understand what that represents. That is not a small technical adjustment. That is an entire year of market assumption being quietly rewritten in real time. And most people holding cash bonds or retirement accounts built around the old assumption have not caught up to it yet. Now, why would 3 Fed officials take a stance that unpopular, that early, and that publicly? The answer is inflation. And it has been sitting in the room the entire year, mostly ignored by anyone hoping for relief. Inflation has remained stubbornly above the level the Fed considers acceptable, and this year was compounded by a genuine geopolitical shock. Tensions in the Middle East pushed oil prices sharply higher for a stretch, briefly approaching $90 a barrel, as the United States moved toward direct military action against Iran before pulling back at the last moment, after key regional allies pushed for a negotiated path instead. Energy shocks feed directly into inflation, and inflation that stays elevated for long enough stops looking temporary and starts looking structural. 3 officials inside the Fed appear to believe the country is closer to that second scenario than the market wanted to admit. If you are finding this useful already, take a moment to like this video and subscribe, because the next part is where this stops being an abstract policy story and starts becoming a story about your own money. And I do not want you to miss the mechanism, because it is the part that explains the paradox I opened with. Here is the mechanism explained as simply as I can make it. When interest rates rise or are expected to rise, holding cash and bonds becomes more rewarding in the short term because you are paid more just for waiting. Gold pays you nothing for waiting. It sits there. So when rate expectations shift toward hikes, the fast money, the traders, the short-term speculators, the leveraged funds, all of them have a rational reason to rotate out of gold and into interest-bearing assets. That is exactly the force that pressured gold for much of this year. And it is a big part of why gold sits roughly 28% below the record high it set back in January, even after a year in which almost every macro headline seemed to favor it. But underneath that fast money sits a second, completely different kind of buyer. And this is the buyer almost nobody in the public conversation is talking about. Central banks do not trade gold the way a hedge fund does. They are not trying to catch a short-term bounce or avoid a short-term dip. They are converting a portion of their national reserves, slowly, deliberately, over years, away from paper promises and into an asset that answers to no government, cannot be frozen by a foreign power, and cannot be inflated away by anyone printing more of it. When you understand that distinction, the paradox stops being a paradox. The fast money left because rates might rise. The patient money kept buying because rates rising or falling changes nothing about the deeper reason nations hold gold in the first place, which is trust, and trust in paper promises has been eroding for reasons that have nothing to do with any single Fed meeting. And there is a second force sitting quietly underneath all of this that the 3 dissenting officials were almost certainly staring directly at. And it is a number that should genuinely concern anyone thinking clearly about where this goes. The United States government's annual interest expense on its own debt has now crossed $1 trillion a year. Not the debt itself, just the interest payment on it every year. That figure did not exist a few years ago at anywhere near this scale. And it creates a strange and uncomfortable tension sitting directly underneath the Fed's decision. The higher the Fed pushes rates to fight inflation, the more expensive the government's own debt becomes to service, which means there is a mathematical ceiling on how far and how long rates can realistically climb before the interest bill itself becomes politically and fiscally unbearable. 3 officials may want higher rates today, but the room they have to keep pushing is shrinking every single year the debt keeps growing. And that tension between fighting inflation and affording your own debt is one of the oldest and most dangerous binds in the entire history of central banking. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither of these people is real, but both are the kind of person you might recognize. The first I will call Dennis, 68, recently retired, careful with money his entire working life. All year, Dennis read the same headlines everyone else read. Rate cuts coming, the Fed easing. He moved a meaningful share of his savings into short-term cash and money market accounts, reasoning that once cuts arrived, he would have flexibility. And in the meantime, he was collecting a decent yield for doing nothing. It felt like the safe, sensible move. What Dennis did not build into his thinking is what happens if the entire premise reverses. If hikes come instead of cuts, his cash keeps earning a bit more in the short term, which feels good. But the broader environment that produced this reversal, stubborn inflation, a fraying assumption about how controlled prices really are, a government straining under its own interest bill, is exactly the environment in which the purchasing power of that cash quietly erodes, even as the number on the statement looks fine. Dennis is comfortable today and has not yet asked the harder question of what his money will actually buy 3 years from now, if this pattern continues. The second person I will call Yolanda, 66, and she is not wealthier than Dennis, and she is not a professional trader. She simply asked a different question earlier in the year, rather than positioning entirely around a guess about which direction the Fed would move next. She looked at what the most informed, least emotional buyers in the entire financial system, the central banks themselves, were actually doing with their own money, not what any single headline predicted about interest rates. She saw that buying accelerating, saw it continue through a year of tariff fights, a Middle East scare, and a wildly uncertain Fed, and she made sure a modest, deliberate portion of her own savings sat in the same asset those institutions were quietly accumulating, not as a bet on any single Fed meeting, but as insurance against the deeper uncertainty that meeting after meeting keeps revealing. When the dissent hit last week and the market flipped its own assumptions overnight, Dennis had to rethink his entire plan. Yolanda did not have to change anything at all. The difference between them was never intelligence, and it was never luck. It was that Dennis built his plan around predicting a single number, the Fed's next move, and Yolanda built her plan around a pattern that holds true regardless of which way that single number goes. Now, why does this keep happening? Why do so many careful, intelligent people end up like Dennis, chasing the direction they were told to expect, right up until the moment it reverses? There is a well-documented feature of how people process financial information called recency bias. Whatever has been true recently feels like it will keep being true indefinitely, simply because it is the pattern the mind has grown used to. For most of this year, the dominant story was cuts are coming. That story got repeated so often in so many places that it stopped feeling like a forecast and started feeling like a fact. When 3 officials inside the Fed quietly broke from that story, most people had no framework ready, process the reversal, because they had never seriously entertained the alternative. This is exactly why the most damaging surprises in markets are so rarely the ones people were worried about. They are almost always the ones that felt too unlikely to plan for. There is a historical echo here worth sitting with for a moment, because history does not repeat exactly. But it rhymes in ways that are genuinely useful. Go back to the late 1970s. Inflation had been running hot for years, and for a long stretch, the Fed moved cautiously, worried about hurting growth, hoping the problem would fade on its own. It did not fade on its own. It eventually took a dramatically more aggressive round of tightening, uncomfortable, unpopular, and painful in the short term to finally break the back of that inflation. The lesson those years left behind is a simple one that the 3 dissenting officials last week were almost certainly channeling. Inflation that is allowed to run because acting feels too costly in the moment does not usually resolve itself gently. It tends to demand a larger and more painful correction later, precisely because the easier path was chosen for too long. Whether today's Fed follows that same arc or manages a smoother landing is genuinely unknown. But the dissent itself is a signal that some of the most informed people in the building are worried about exactly that pattern repeating. Now, let me be honest and careful with you, because I will not insult you with fear. And this subject draws people who want to frighten you into a rushed decision. Nobody, not me, not any bank, not any analyst, can tell you with certainty that a hike is coming in September. The market is pricing roughly 2 out of 3 odds, which means there remains a real meaningful chance it does not happen at all, or happens later, or happens in a smaller size than expected. Friday's jobs report and the string of labor data arriving this week will meaningfully move that probability in either direction. And it is entirely possible a weak print pushes the Fed right back toward caution. Gold itself remains a genuinely volatile asset, still roughly a quarter below its January peak, and anyone promising you it is guaranteed to do anything specific in any specific time frame is selling you certainty that does not exist in this market or any other. What I am giving you is not a prediction of where the number lands next month. It is an understanding of the mechanism so that whatever the Fed actually does, you are not caught flat-footed, the way an entire market was caught flat-footed 8 days ago. I want to say a word about silver here too, because it sits inside the same story but moves through it differently. Silver carries a dual identity that gold does not. It is a monetary metal people hold the same way they hold gold, but it is also a heavily consumed industrial material used in solar panels, electronics, and a widening range of modern manufacturing. That industrial demand does not care what the Fed does with interest rates. A solar manufacturer with orders to fill still needs the physical metal, regardless of what borrowing costs look like this quarter. At the same time, silver is now heading into its 6th consecutive year in which the world uses more silver than it mines, a shortage that has been quietly draining stockpiles built up over decades. That combination, price sensitive to the same interest rate swings pressuring gold, but physically tightening underneath regardless of what rates do, is exactly why silver tends to move further and faster than gold in both directions once a trend actually takes hold. It is not simply a cheaper version of gold. It is its own animal, sitting on its own fault line. This week's Fed reversal runs directly through it as well. So let us pull this together and go back to where we started. 3 Fed officials broke from the rest of the committee and dissented toward higher rates, not lower, warning that waiting too long risks a far more painful correction later. The market, which spent all year positioned for cuts, has now flipped to pricing roughly 2 out of 3 odds of a hike as soon as September. That should be bearish for gold in the textbook sense, and for the fast money, it has been. But the world's central banks bought gold at a 74% higher pace this past quarter than the year before, continuing to accumulate straight through the uncertainty because they are not betting on a single meeting. They are hedging against a much larger erosion of trust in paper promises, one that $1 trillion a year in interest payments on the national debt only reinforces. History from the 1970s suggests that inflation allowed to run too long rarely resolves gently. And the gap between the people caught off guard by this reversal and the people who were never depending on guessing it correctly in the first place comes down to a single choice, whether you build your plan around predicting one number or around understanding a pattern that holds regardless of which way that number moves. Here is what I want you to carry away from this, stated as plainly as I know how. This does not mean panic, and it does not mean abandoning cash or bonds, because balance and stability matter, especially for anyone near in retirement. It means asking yourself honestly whether your entire plan is quietly resting on a single assumption, that rates were about to fall, an assumption that just cracked in a single week without most people noticing. It means understanding that a modest, deliberate allocation to an asset the most informed institutions in the world are already accumulating is not a gamble. It is insurance against exactly the kind of overnight reversal we just watched happen in real time. The right size of that allocation depends entirely on your own circumstances, your own timeline, and your own comfort with volatility. And I am not here to tell you the number. I am only here to make sure you are finally asking the question that 3 Fed officials just forced into the open, whether they meant to or not. Do not let anyone use this moment to rush you into a costly decision, because there will be people trying and they will get louder the more this story spreads. And do not dismiss it either. Telling yourself a single Fed meeting could not possibly matter to your own plan, because the market itself just proved in 8 days that an assumption an entire year was built on can break overnight. Those are 2 different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, the 3 dissenting votes, the September hike probability, the 289 tons of central bank gold purchases, the $1 trillion interest expense, the silver deficit, comes directly from the Fed's own July statement, the World Gold Council's most recent report, and the market pricing tools professionals use every day. So you can verify every word of it yourself rather than take mine. I opened by telling you that if any part of your savings assumes rates are about to fall, this changes your next 30 days. Not in theory, but literally. Now you understand why. 3 people inside the most powerful financial institution in the world just told you, in the clearest way officials like that ever tell you anything, that the story you were sold all year may already be wrong. So let me leave you with the question underneath all of it. When the assumption your entire plan was resting on breaks overnight, and it just did, is your money built to survive being wrong? Or was it only ever built to survive being right?